message. So today we are going to discuss, going to start the final session, final module of the program, recovery management. So we'll discuss today these 3 days. What is recovery management? What are recovery options available? How to apply for recovery? Okay. Deposit make the bank impossible. We see it on the. Okay, sorry. Okay, deposit make the bank impossible. We are financial intermediaries. Banking is all financial intermediaries. That is, collect deposit from the customers or those who have surplus funds and lending to people who have been needing. So lending makes the bank profitable. Our main business is financial intermediation, collecting deposits and lending. But NPA makes the bank perishable. If the lending not collected in time, according to the schedule, bank will perish. That means bank cannot survive. Not only the bank, any lending institution cannot survive. So therefore, lending is a very enjoyable thing. In the granting facility, most of the bank we very happy about. The customers are happy, bank was happy when you're granting the facility. But when it comes to recovery, then it's completely bitter position. Customers having a bitter position, bank also facing bitter experiences. Therefore, it's very important to understand the concepts. According to the seniors, how they define the loan, loss of assets due to non-payment. Loan is defined as loss of assets due to non-payment. Whose asset is this talking about? Whose assets? It is the bank's asset. So all lending is a receivable, so it is an asset in our balance sheet. This is the current assets operating day to day. So when the assets are not collected in time, the bank has to face financial difficulties, liquidity crisis, and borrow at a high interest rate to set off the shortfall. And finally, end of the day, we are end up with a loss. Therefore, we have to maintain the asset quality. This is the most important thing we have to understand. What is asset quality? Right? Now, this is very important. The assets are our major source of investment. We invest the asset, that we give this asset, lending to the customers, and we earn an income. So that is the interest or the profit. So any business looking for profit, not loss. There are certain, compared to the other businesses, the banking business, so the financial industry, we have a crucial position because we are lending others' money, other sources, shareholders' money, collector loan money, or depositors' money. Those are all external sources. So any non-payment of what have given the loans will lead to a loss where we may not be able to pay back their money. We may not be able to pay back their money. According to the Banking Act number 30 of 1988, section 86, it says, our job is financial intermediation collecting deposits and payable on demand. Whenever they ask, we have to pay. Whatever condition we put, end of the day, if a customer comes and asks his money back, we have to pay. So we have to ready to pay back. So therefore, we have to maintain our liquidity and the solvency. So non-payment lead to loss of this problem of driving for losses. Impact on non-performing losses, there are a number of impacts in our scenario. Let us discuss one by one. It is the first law of finance. Return of your capital is more important than return on your capital. Return of your capital is more important than return on your capital. What is return of your capital? It's a money lent capital. That is more important than return on our capital. Return on the capital means the interest component. Right? If you look at how we operate and they take into consideration, the law of finance is return of the capital is more important. That is first priority to recover the capital given, because that is affecting the balance sheet. Our asset quality. And the return on your capital is the income, it is affecting our profitability. Both are important, but in the case of for a survival of a bank or financial institution, the capital deterioration is very serious. Therefore, the impact on non-performing advances strictly talk about returning of the capital. Okay, let us see how in the practice we are doing. What is we recover first? When a customer's installment, what we recover first? Capital or interest? Manually you are recover the interest first. Then what is remaining only you are adjusting for the capital. Even our systems has been developed. When your customer's money comes to the account, immediately recover the interest and thereafter capital is recovered. Now, according to this principle, law, it's incorrect, no? Look like incorrect. Okay. What is important here is I understand circumstances. Now, if it's a regular loan, regular facilities, regular loan, it recover the installment, the capital and the interest will become in the installment. Whichever you recover first does not matter because in the regular loan, both are coming simultaneously. So there's no impact on that. Whether it recover first the capital or capital interest, both are recovered simultaneously. Therefore, this concept has to be applied when it comes to recovery of defaulted facilities. Recovery of defaulted facilities, we have to be alert on this. Now see, look at this. Someone may argue that you recover capital and without postponing recovery interest will affect our balance sheet, the P&L, profitability. Let's see how it has been affecting. Okay. Now, this has twofold benefits. The capital recovery. We have to understand why customer is defaulting. When it comes to defaulted or facilities recovery, we have to be careful, understand the background. What is recovery? Customer, why defaulted before the recovery? But because he didn't have the cash flow to pay the loan installment on the due date. That's why it's called in arrears and transferred NPA. So we have to understand that. Some may think that it is purposely done, very rare cases, because in common factor is that due to certain factors, It can be internal factors, customer side. It can be some problem with the bank side or external environment side. Something happened where customers' cash flow is got deteriorated, where we could not recover our loan installment, and it fallen in arrears. Therefore, recovery management we talk about understanding the problem of the customer, understand the problem of the customer, what has happened to the customer. That's what in detail we are talking about, to look into in detail why customer has defaulted, what went wrong with him, what are areas it has gone. So that analysis, we need a lot of information. Internal information, external information. Need a lot of information. And once we identify the problem by the cause of default, we may be able to rectify those defects. And then the customer may be able to continue the business. So on the other hand, we are talking about the recovery management is trying to make customer ease or solve the customer's problem. Solve the customer's problem. Non-performing is our problem. No. Non-performing is our banker's financial problem. Then solution is with them, not with us. Solution is with the customer. The customer has to generate some income to settle for arrears. Therefore, solving the customer problems, automatically our problem will be solved. We don't have to break our heads to do recoveries and attend this management recovery program, right? Everything based on customers' cash flow. So we have to identify what went wrong with the customer, why the cash flow deteriorated, and put back customer, rectify that. Then you may be able to recover our whatever defaulted receivables. So therefore, it is important to understand customers defaulted for some cause, some reason. Our job is to find out why customer has been defaulted and try to rectify it, correct it. During the course of this action, you may find customer may not be able to pay entire outstanding advance, although we demand. We send letters and demand letters only. No, before such a pay such amount. We send letters. We think we are happy about sending letters. We try to recover from, solve the problem from our point. Never happens. Why? Customers should earn income, generate income to pay. So your letter will not generate any income of the customer. We have to understand that. It's only a document to remind. That's all. It's not a recovery mode. Therefore, customer problem that I understand, identify, try to solve that. If it's solved, our problem is automatically solved. During this course of period, customer may have some cash, so he may agree to deposit some money. Deposit some money. What will happen now? What will happen now? When the customer deposits that money into the account, immediately system will take off their interest and left behind the capital as it is. Although customer tried to settle some with the available cash flows, his problem is not solved. Our problem also not solved. Why? NPA balance is not coming down. NPA balance is not coming down. Only our recovery interest and the return is going to P&L, and we are enjoying our profit is increased. Customer is the same place. Our NPA also in the same place. We have to keep in mind that. Therefore, it is suggested by the senior bankers, whenever customer has defaulted and you have applied a recovery plan for them, whatever customer's cash flow comes, you recover proportionately. You recover proportionately. That means part for capital recovery, part for interest recovery, depending on the customer's ability to repay or ability to use cash flow. Part for capital, part for that can be 40, 60, 40% for loan, 60% for interest, or other way about. 60% for loan, 40% for interest recovery, 50-50 likewise. This is proportionate recovery. Then what happens? Has a twofold benefits. You look at the customer's point of view. Whenever you recover part of the capital, customers' pressure on repayment of capital is coming down gradually. This pressure on liability coming down gradually. And he'll be easy in mind. You know that one thing. Secondly, payment of interest on the capital will also coming down. Interest payment on the capital also coming down when you recover capital, a portion of the capital. Thereby, on the two folds, he is getting benefited. One is his outstanding balance is reducing, his interest payable also reducing. Therefore, he will be having a cushion, some sort of cushion. Having. What is the bank's position? Are we losing? We are not losing. We are not losing. We all, a portion of the interest also coming to our growth. Capital for survival, interest is for growth. So part of the interest also coming out as our income. It's coming to our P&L. And also, there's a hidden benefit is there. There's a hidden benefit for the bank. We are not understood that. We are not seeing this. That is, when the NPA, non-performing position is reducing, NPA position is reducing, the provisioning on NPA will be returned back. It will be coming back, it's reduced. So it will appear in the P&L as an income. There's no book entry whatever, but the recording system will automatically calculate the provisioning based on your capital. So the capital reducing, your provision also coming down. If the provision is coming down, whatever you already made provision will be returning as an income for you. So bank is not going to lose. Bank is not going to lose. So you'll understand that very carefully. Okay. I discussed earlier that maintenance asset quality is very important. When non-payment is increasing, what is impact for the customer? What is impact for the bank? A lot of implication we are having at the moment. When your NPA is increasing, your non-performing, the asset quality deteriorates. One of the key performance measuring indicator for the bank or finance company is ROA, return on asset, profit and asset relationship. So therefore, when NPA is increasing, one hand income is deteriorating. So profit is deteriorating. On the other hand, asset is not moving, asset is increased. Therefore, the proportionate of ROA will be deteriorating. If the ROA is deteriorated in any financial institution, the investors, not the depositors, the investors are investing in shares, buying financial instrument, customer may not come forward. You may not find the investors for the business. It has happened in the past for a number of banks, even the recently, when the losses are increasing. So this information you publish in the newspapers. Earlier it is a secret of the inside. But today, according to the Banking Act and the Companies Act, you have to publish quarterly your projected your draft balance sheet of the P&L in the newspapers. So anybody have access to the information. Is vital. Therefore, maintaining asset quality is very important. Right? So ROA is a big impact on our. Just little later, I just tell why at the moment what type of a situation we are facing, crisis situation. Outside the pandemic and all this economic crisis, among that we are internally also certain crisis situation we are facing for it. Okay, yeah. So maintaining our asset quality is very, very important. So the NPA is very recover NPA or reduce the NPA, not allowed to transfer NPA is very important today. Well, okay. Our debt recovery management is not Shylock's method. You can see on the right hand side how the banks are now trying to recover. Customer ඉබදාලා පාගලා ඔක්කොටේ ගන්නවා ප්‍රෙෂර්. කස්ටමර් කකුල් දෙක ගන්නවා හොල්ලලා සංස්කෘතිය ඔක්කොම හලා ගන්නවා. This is Shylock's recovery method. Because recovery of interest, Uncle given that, so it's a policy of street lenders. Because they want to survive, they want interest, income. So capital not recovered, as much as they keep the capital, you can keep on earning interest. But in institutional lending, banks and finance institution, we cannot do that. We have to recover the capital. Otherwise, our survival will be threatened. When the NPAs are increasing, our NPA ratios are increasing, our performance will be deteriorated. We may not be able to go for any further investment. So, end of the day, we have to close down those on solvents. Okay, so debt recovery management is very systematic, professional approach. It is not tell the customer or ask the customer to pay this loan or whatever customer's money available, you try to recover your loan, but not the loan, and mostly they recover the interest. That is not recovery. It should be a win-win situation. It should be benefited both parties, bank as well as the customers. Customer, not to put the customer in difficult situation. Try to help the customer to come out from his problem. That is our role. In debt recovery management, we are focusing on that. Try to solve his problem and try to recover his problem. Automatically, we are recovering our problem. Why recovery management is important? The recovery of default credit facility. What is recovery management? It is recovery of default credit facilities. Therefore, when you talk about the recovery management, it is for the regular loans. It is for the regular loans. It is the defaulted facilities we are going to cover. It is involved in enforcing collateral. Finally, when the customer's cash flow is deteriorated, cash flow is not coming forward, other option available is whatever collateral given to the bank or the financial institution, we legally enforce to recover. Enforce to recover. In other words, liquidate the collateral and try to recover. That's a final option available. Therefore, when you talk about recovery management, liquidating collateral is not the first option. It is the final option. All other measures are taken to upgrade the customer's income source, cash flow. If everything failed, only go for the liquidating of collateral. It is liquidating the asset charged to the lending institution. Final last option available is liquidating the asset charged to the lending institution. It is therefore recovery of default facilities and secure documentation are two sides of a coin. What's that? Recovery and documentation are two sides of a coin. That, in other words, if the documents are not perfect, you may not be able to charge the collateral based on that documentation, based on that documents. So the documentation is the most crucial today, very, very crucial in almost all the banks and finance institutions when they go for recovery management. When the case is defaulted, final option is to charge the collateral. When you're going to charge the collateral, we find it is not easy. Why? Our documents are weak. If the documents are incorrect, or if the documents are not according to the law, there are a lot of problems we have come across. Because at the time of granting the facility, we take everything very, very comfortably. Even the executing the documents is also a very simple thing. Just that's not paid much of attention, much of a seriousness in the executing documents. You look at the document, when it comes to defaulted. The documents are needed to enforce. If the documents are not perfect, we are facing difficulties. Today we are facing this problem. Still, this is the main problem in the bank where the recovery is concerned. Concept of the technical management. This management process needs to start at the loan initiating stage. When to start recovery? When to start recovery? Recovery start before the granting facility. When you negotiate with the customer, the first question you ask for the customer, what is it? What is the repayment source? How are you going to pay the loan? What is the income source? Okay. If it's an individual or regular income, you verify income before processing the facility. If it's sufficient only the recovery, we go ahead. Or else, we take the financials of a business customer and analyze the profitability and the cash flow before granting a facility. So our recovery starts at the time of negotiating for the relief facility. Recovery starts at the time of negotiating for a facility. Effective management of recovery and non-performing assets are comprised to prolonged strategy. Right? Effective management of recovery management, and non-performing assets, NPAs, comprise two prolonged strategy. First, to relate arresting of the defaults and creation NPA thereof. Arresting the defaults and creation of NPA. Second is the handling of loan delinquencies. Now, what are these two strategies? First is arresting the default, not allowing the facilities going into default, and creation of NPA. So this is the most important part. After transferring the NPA, doing the recovery procedure is handling of loan delinquencies. The second component. First component is easy. Second component is very hard. When it's defaulted, it's not easy to tackle the customer to get back the money. But if you are identifying the customer's problem in advance, observing his behavior, observing his current account pattern, observing his repayment method, you may understand. So next session we are going to discuss this policy, supervision, follow-up, and policy symptoms. So arresting the default is the first. Now this part we call as remedial management. Remedy the situation. Remedy the situation, environment, whatever it is. What has happened? What is the cause for customers facing for difficulties before the default? You may understand because no facility has been transferred to NPA overnight. No facility is transferred to non-performing section overnight. It's a process of time. You can understand the customer's account is deteriorating, his cash flow is deteriorating, he's delaying in his settlement. Like that, this is gradually growing. So during that period, if you do the remedial management to arrest the situation, our NPA will come to control. So now this is very part is the remedial management part is now very important. The empowerment focusing on that. Okay. The tenets of financial sector reforms were revolutionary, which created a sense of urgency in the minds of staff of bank and gave them a message that either they perform or perish. Right? Tenets of financial sector reforms were revolution. It created a sense of urgency in the minds of a staff of bank. Give them a message that either perform or perish. Perform or perish. And this is the message given. Right? The prudential norm has forced the banks to look into the asset quality. This is the most important part. Now if you look at this message given to the specifically staff. If you are not performed and if you are neglected, if the NPA has been increased, finally what will happen? Bank or the financial institute may collapse. If you collapse, what will happen to your job? That's what they understand. So what will happen to your job? So it is personal. Debt recovery is personally attached to our career. Recovery is defined as process of regaining and saving something lost or in danger of becoming cost. Improving recovery management is an requiring expeditious and effective action in legal, institutional, and judicial process. Banks at present experience considerable difficulties in recovering loans and enforcement of securities charged with them by the reason. Right? Effective actions in the legal, institutional, and judicial procedures. To what extent our actions are based on the legal background, or to what extent we are following the legal requirements in a waiver recovery. Most of the time we have found when it comes to this situation, it was quoted with us. Why? Either our documents are incorrect or our actions are not according to legal we may lose. Banks experience considerable difficulties in recovering loans and enforcement of security charges them. Why? This is the most difficult part when you try to file action only courts. You come across these difficulties or the shortcomings in the documents. If you have a opportunity to go to courts, Colombo district courts or a district court, whenever these banking matters are taken, you may see that what extent we are we can no each other what type of bulls we have passed in our documents. When the documents are weak and we may not be able to recover, now cases are thrown away. These are scholar in the house. Legal department. Documents are the no. They prepare the documents according to the legal system record. Legal background, whatever requirement on the law, they prepare on the legal document. But the problem is, who is executing the legal document? Who is executing the legal document? It is you in the bank or in the finance institution. You, the manager, legal officer, credit officers are executing the legal documents. So most of them, we are not aware what is required in the legal law when executing the legal these documents. So this is the problem we are having at the moment in most of the banks branches. The staff is lacking of this knowledge. Therefore, our documents are getting weak. Our documents are getting weak. Right? Therefore, it is important the documentation part. Documentation is very, very important. Although the set documents are there, when it comes to execution, we may not have taken the signatures in the proper way. We have not verified the signature of the document with the other documents in the bank. For example, customer's account signature and the loan application signature and the loan agreement signature. One to one differs. So when this document, loan agreement, if the signature differs from our specimens, earlier specimen, customer challenge and tell this is not my signature. When you go to courts, you have to prove this is customer signature. Can you do it easily? After you tell the judges will accept, they listen to both parties. So you have to prove it. If so, customer will call for our earlier documents. When you compare, when you see a different, then we are liable. Yes, yeah, we will have to recover. Similarly, there are certain legal requirement on registration procedures, stamp duty. All these things the branch people should know, not the legal officers. Legal officer prepare the documents sent to the branch. We should know what to do and what to get out. Most of the instances, the changes taking place are not updated. We are outdated. Latest position changing in the legal, and I think has not been convinced to the staff below the line. These are the practical issues we have come across in over recovery. And therefore it will become a cost and a loss. Okay, the excessive procedure for recovery debts due to banks has blocked significant portion of their funds in unproductive assets, the value of which deteriorate with passage of time. Now, excessive procedure to recovery, it has blocked a significant portion of our investors' money in this non-performing. Day by day, this is increasing. Day by day it is increasing. There are alarming situations when you look at the central bank reports, entire industry, for example. It is alarming. Last, I think 2020 report, when I looked at the report, I saw that the loan portfolio has not increased. The slight increase has been there. Right? The transfer into NPA is much more than what you have been granted. Transfer to NPA is much more than what was granted. This enterprise report. Shocking. What extent we are weak. So this is not straight away we put the blame on the branch managers and the credit officers. Bank management also should take responsibility for this. The bank management not understood the environment and the background of each and every branch coming under them. I'll give you an example. Now, most of the time, the managers are given targets. They have to achieve the targets. Right? Now, market is deteriorated. There's got difficulty to find out quality borrowers. So, therefore, if we have not achieved the task, your performance will be affected. Performance cannot achieve the task. Therefore, most of the managers are trying to expand the loan portfolio. Anybody comes, not looking at the qualities, not to get all. Whether the customer can pay back the loan or not, end of the day, NPS become a value. This is one of the causes what I have found. Secondly, without understanding the environmental factors. Now, environmental factors, understanding the recessions and other things, we try to grant facilities. Cannot be served. It cannot be served in the market because due to the economic crisis situation, the economy has been shrunk. So you lend such industries, it will not produce any income. It will not, because the economy is not moving. You'll understand that. So we have to go for what reduce. Right? Now, very important factor here, one of the important factor here is when we do recovery, we are charging assets, right? Most of our loans are backed by property mortgages. Most of the bank managers, the loan or credit officers, asking us from the customers immovable property as collateral. My question is, in the case of a default, to what extent it is liquidated? To what extent you can liquidate those assets quickly without going for a long period? More the delay, more the cost. Interest will be accumulated, legal costs will be accumulated. Sometimes value of the asset may not be sufficient to cover over a period of time. This is what happened today. So to understand that, to select the correct collateral. So the property mortgage is one of the most hard collateral which are very difficult to liquidate. Either going to the parade or filing a mortgage action. Take a time, consume. It's not easy. Most of the parades are conducted by the banks are unsuccess because there's no buyers. Bank has to buy. Bank has to buy. Right? In the parrot is unsuccessful, bank has to buy. Once it bank buys, what happened? It is in our books, the fixed assets, but it is not performed. We calculate NPA non-performing on the current regular facilities only. This type of facilities are ignored. So our correct position in the banks are not shown properly. On the fixed asset, there are a lot of portion after the Pareto, after the mortgage auctions were failed. Selling actions were failed and it's appearing our books. But it is not showing as our NPA. Those assets are not generating any profits. Wealth is there, no income. So our ROA further deteriorates. Right? Right. What is non-performing assets? Now, what is banking besides we say financial intermediation? Customer deposit money is our liability product. And we give these deposits to customers, those are assets of our bank. We give to customers. In turn, customer will pay interest to the bank and pay interest to the depositors. That's the procedure. If the customer gives us the interest, we pay the interest to the customer, our depositors. But when the loans are converted to NPA or stress loan, this interest income is not coming. So how to maintain depositors? To pay interest to the depositors, we have to use our own funds, our own methodology. Passage of time, bank will deteriorate. This is our problem. Right. Now, I took a small portion of the Central Bank report. This is 2018 situation. Therefore, I just want to show our position and present. We'll discuss about the present position. In 2018, banking sector profits came under significant pressure from the additional impairment provision, coupled with increased tax implemented under Inland Revenue Act into April 2018 and the International Debt Payment Levy effective October 2018. Overall banking sector profit were declined by 9.1% in 2018 compared to significant growth in 18% in 2017. Point disallowed banking sector income growth in 2017-2018 was 18.9%, whereas 2018 profit has been declined minus by 9%. There are two reasons. One was the impairment regulation implemented in 2018. Okay. Secondly, Bangala summary budget, we introduced the Inland Revenue Act debt repayment levy from October. What is this debt repayment levy? 2018 budget was introduced. For 3 years, 2019, 20, 22. For 3 years, all the banks has to pay a levy on them 7% from their profits. Levy on the Inland Revenue Act, 7% levy on their profits. So the profits have been declined because of that. Right? So in 2019, when this new government came into all the taxes applied by the former government has been removed. Former government has been removed. Inclusive of this debt repayment levy effective for the October. But the president was telling that about this removing debt repayment levy on the banks, But he was telling that at that time, the banks have more money to invest without paying tax. Now, what is this debt repayment levy? What is the debt repayment levy? This is a debt repayment levy is the funds collection, what do you call a fund built on the banks from their profits, not from the operation, right? So if it's operation, it can be put into the customers. This is from the profit, therefore they cannot put it to the customers. Straight away, bank has to pay, and it has no impact on the people in the country to repay our loans, external loans, what are borrowed by the government, external loans. External loan given the we debt repayment levy apply karla. So it for 3 years the government will continuously 2018 to 2023 make apply karla. But this government came and removed everything, inclusive debt repayment levy. Now we are struggling to find money to repay our external debts. $500 million, $1 billion. Fund එක හදපේක අයින් කරලා දාලා. සමහර ඒවා තියෙනවා politics TV මේවා. You understand මේවා impact එක ගැන හිතන්නේ නැතුව but as it is නිකම් අර lobby talks වගේ okay taxes අඩු කරා තමයි all the taxes are removed fine inclusive මේ taxes උත් අඩු කරන්න අවශ්‍ය නැහැ. It is not affecting the people. Cost of living එක කවුරුත් බලන්නේ නැහැ. Right? Anyway, so now these are levies are no more there. The impairment regulation also amended from this year 2020 to January. So we'll discuss that one. So there are a lot of other some changes have been taking place in the environment. But there's a big important thing coming into the entire market. Sectors ROE, return on equities, are likely to remain substantial and unattractive to investors due to capital rising effort made by the banks in meeting and exceeding capital requirement. Now, Central Bank in 2016 increased the capital of commercial banks from 10 billion to 20 billion. Specialized banks 5 billion to 7.5 billion. The capital has increased. 2017 or 2018, it has affected. Then condition is you can issue shares, you can transfer from internal profits for reserve and increase the capital requirement. Okay, no loans, the loan money, it is the capital. Right? Now with this background, some of the banks who issued shares to the market was undersubscribed. It was undersubscribed. Look at the fish reports or reports of Colombo Today reports of right? Because ROE, return on equities, because of these two cases, it was came down, and investors, unattractive investors, and to raise the capital, issue new capital were not successful. So the other alternative is to retained profit has to be increased. When the profit has been deteriorated due to the NPS increasing, you may not be able to increase your capital base, equity capital. Right? What is the impact of this? Where a licensed commercial bank or licensed specialized bank has failed to comply with these directions. Right? What the direction? To increase the capital by 2020. Target date was 2020. 2 years were given, 2018 to 2020. Capital not increased up to 20 billion. specialized bank 7.5 billion. Right? What is the repercussions? These central bank guidelines circulate, directives and issue to the public. Where an LCB or LSP has failed to comply with this direction, that is, increasing the capital up to 20 billion and 12.5 billion respectively, such LCB, licensed commercial bank, or licensed specialized bank, shall not pay dividends, or repatriate profits. Not to pay dividends, not to repatriate profits foreign banks, or adopt any other measure that will further deteriorate the capital of such LCB or LSB until such compliance is effected and confirmed by the director of the banking supervision. මොකද්ද මේ කියන්නේ? 2020 වෙනකොට capital is 20 billion ගෙනාවේ නැත්තම් ඒ banks profit එක dividends ගෙවන්න බෑ. So what will happen to the private banks? If you are not paid dividends, what will happen? Share prices will collapse. Share prices collapse, the banking sector will be collapsed. Malik selling in line. So that was there. And second, adopt any other measure that will further deteriorate the capital. Capital like profit take කරන හැමදේම and suspend. Now what are those things? No branch opening. මේ තුන list එක මම අයින් කරා මම පරණ නිසා. No branch opening, no new branch opening, no recruitment. That bank should not recruit any employees. No branch expansion, new branches cannot be opened. No promotions and internal listings. And no what is effective profit, personal benefits, housing loans, bonus, medicals, certainly this measure will further deteriorate the capital. We will come and curtail. So we are facing now this is a difficult situation. The restriction in terms of asset growth or branch expansion will be imposed. Restriction in terms of asset growth, branch expansion will be imposed on the LCBs and LSPs which are not compliant with the above directions. Indrajit Kumar Swamy, Central Bank, Chairman of the Monetary Board and the governor, former governor. He's a circulator issue 2020 achieved. Now due to the corona, thank for corona, thank for corona. Now this has been suspended and postponed till 2023. Cancel next year it will come up. This next year, this will come up. 2023 December, all the licensed commercial banks have to increase their capital up to 20 billion. All the specialized banks that increase their capital from 5 billion to 7.5 billion. So two options available. One is going for public share issue. Second one is internally increase their profits. Right? Now what is the position of NPA? How will it affect NPA will affect for this background? When the NPAs are increased, I told you, ROA income is coming down, NPA asset will increase, return on equity, return on asset will be deteriorated. So the share issues may not be successful. There was an issue 2 years back. One of the banks issued shares to the public to increase their capital. It was undersubscribed. Even underwriters were withdrawn from the underwriting. So they had to withdraw the application of security exchange. that particular bank in Sri Lanka. So this is the situation. We should know what's happening in our environment. Now this situation, some similar situation was arising in 1986. In 1980s, the recession, worldwide recession, the Basel regulations were started. The Basel was established. BIS, Bank for International Settlement, was established. And the first convention, Basel Convention, Basel I, they introduced the capital adequacy ratio. There's the capital and the risk asset ratio should be 8%. By that time, at that time, 1986, in Sri Lanka, none of the banks have been compliant with that level. Almost all the banks have the capital and the assets, that is loans, balance were not, this is more than that. So therefore, most of the private banks were issued shares and build up their capital to balance this. When it comes to state banks, Bank of Sri Lanka, People's Bank, and also NSB, these are state banks. So what the banks ask from the government, so the state bank, to fund necessary capital to the banks. At that time, President Jaya Jawardhan was there in the government. He rejected this request. He said, no, we are not giving any funds to the bank to privatize these banks, two banks, according to the World Bank guidelines. All three banks has to be privatized. That's special government. Then the unions were, everybody fought for him. And ultimately, we were able to stop that privatization. But due to certain conditions. What was the condition in 1986? No branch opening, no branch expansion, no recruitment, no new recruits, no promotions. Internally, curtail the loans, housing loans are limited. Some period. Bonus the making effect to one of the victims. I am one of the victims. No promotion for 10 years. No branch opening, nothing. Till it is built up. Must say, Musal and Hamilton consultancy firm, when they did, okay, the government have given the something bonds and increase the capital, nationalization probably. I don't know whether you can remember in 2020, maybe 2018, when this issue of increasing the capital loss came into scene, State Bank is not balance. Rajya Bank ko Paugdali Kiriman also begin. Again, same threat has come. Again, same threat has come to the state banks. Still, the threat has not gone out. It is postponed till 2023. Let's see. The economic conditions are actually present pandemic situation and other things have been removed, and today's present economic crisis situation, all the business has been deteriorated, even the bank business has been deteriorated due to lack of foreign exchange. The foreign exchange business, of course, is come to a standstill. Right? So, INSA, maybe sometime we may get a chance for a further extension. Hopefully. If the situation comes to normal, if the central bank strictly implies that capital has to increase, if we have not ability, to increase our capital, cannot increase the capital, we have to face to the sequences. So this is the threat we are facing, external threat for our server. So recovery is very, very important. We cannot avoid doing this. We can't allow our facilities going bad. It has a very, very large impact on our survival, future survival. The threat came in 2020, in 2018, in 2020, luckily Corona has safeguarded us. It has increased, extended up to 2023 December. So 1.5 years more. You know what takes in the bank has been built up their capital to meet this requirement. Otherwise, the mergers, some bank has to merge, some bank, if you not meet the requirement, some bank has to close foreclosure, some bank has to merge with other banks. This is in the pipeline. So, well, the bank is it. Well, so recovery is the first priority, recovery is the second priority, recovery is the third priority. Okay, let us look at what is the default and what is the loss according to the IBSL regulations. According to the IBSL defines, paragraph 272 of the final report document, 1986, the default occurs when one or more following conditions obtained. It is determined the obligor is unlikely to pay its debt obligation, principal, interest, and fees in full. It's a default. The customer unable to pay his debt obligations, loan amount principal, interest, and fees. The creditors even associated with any obligation of the obligor, such as charge of specific provision, interest, or fees. Right? If the charge of mean what is secure documents. Many secure documents are not enforceable and also heading for a default. The obligor is more than 90 days of past due on any credit obligation, it's a default. The obligor failed to file for bankruptcy or civil protection from creditors, also default. If the customer was good, but there's a bankruptcy case filed by creditor to a customer, that customer also treated as a default. So this is what IBSL defines, IBSL regulation defines what's a default. According to section 339, loss should be included discount effects, funding cost, and the direct and indirect costs associated with the collecting on the instrument on the determination of loss. The bank should not simply measure the loss recorded in accounting record, although they should be able to compare the two. So basically, IBSL introduced a system where the loss is considered based on the availability of collateral back. But today it has been changed now. In 2022, January, this loss classification has been somewhat changed with these new impairment regulations. Let us see later what are these impairment regulations. Okay. What is credit risk? There are banks facing a number of risks: business risk, market risk, strategic risk, interest rate risk. But most important risk is the credit risk, because from our total balance sheet, credit is presenting about more than 70%. Our advances are in the balance sheet more than 70%. Therefore, high risk in the performance of these advances. Credit risk is most simply defined as the possibility of that the borrower or customer will fail to meet the obligation in accordance with the agreed terms and conditions. Fail to meet the obligations, that means repayment, in accordance with the agreed terms and conditions. Agreed time, agreed currency, agreed amount. Not fulfilled, complied, then that's a risk. This includes non-repayment of capital and or interest within the agreed time frame at the agreed rate of interest and agreed currency for foreign currency loan. So when we define the credit risk, we identify three areas where credit risk arises. Credit risk again, areas do not be identified. One is default risk. Second one is exposure risk. Third one is recovery risk. Default risk, exposure risk, recovery risk. What is default risk? What is default risk? Default risk is the borrower's inability to make the relevant installment or interest on the specific dates due to deterioration of the cash flow or the income source. Right? That is, the income is deteriorated or cash flow is deteriorated for some reason. This default rate may arise. Customer will default. Default means will not pay the loan installment. When the number of installments accumulates, we'll discuss the different categories. Normally, after 90 days or 3 installments being defaulted, it is we call a NPA facility, non-performing facility. So default risk arises when the customer's cash flow is dried off or deteriorated due to some reason. It can be natural hazard, it can be uncontrollable factor, it can be a controllable factor, it may be willfully, then default can take place. Second one is exposure risk. Credit exposure. Now, credit exposure we discuss in two ways. Two ways we discuss. One is individual exposure, other one is portfolio exposure risk. Individual risk as well as portfolio risk. What is individual risk? Individual customers exposure risk, that is the exposure for default. Exposure for default, how much? Right? That means at a given time, any given time, risk of particular customer of default risk of a customer, or the credit risk of a customer for a given time is the outstanding balance capital amount. Is repayment of capital amount, outstanding balance. At a given time, what the amount outstanding on his advance, that is the exposure risk for the bank. That's a capital exposure. So there's a risk component also there, but we are not considering risk as an exposure because it is not affecting the balance sheet. It's affecting the P&L, not directly affecting. So individual exposure risk means a particular customers at a given time, what's the outstanding balance? That is the risk. Any moment can be defaulted that amount. Next component is portfolio risk. It is the advances given to a particular segment or particular industry or particular area. It's called portfolio. Portfolio is total amount for a particular industrial segment. Right? So that's called collective. Is called using the what is employment regulation is called as collective risk. Normally, our banking we call as a portfolio risk. Right? Correct. The bank has to decide what extent the bank can absorb the risk for a particular segment, particular area. Okay, so we have a bank, all the banks and finance institutions have a separate unit called Assets and Liability Committee, ALCO. So ALCO regularly look for this exposure risk. Look for exposure risk because sometimes a particular industry, a particular segment is failed, the lending to that particular entire segment is getting defaulted. That's called exposure risk. Entire industry for whatever given, it's called exposure risk. For example, in 2013, can you remember what happened to our money? In 2013, the gold prices were collapsed. 2013, gold prices were collapsed drastically. So lending to bowling segment of the entire bank industry has been collapsed. Why? Because the borrowers did not come to redeem their gold articles. It is cheaper to buy new one than redeeming the new existing facilities. Therefore, the industry, that segment has been completely collapsed in the economy, banking sector, in 2013 it happened. Even now it can happen for any sector. Suddenly one sector may collapse. Okay. Then this particular period, one particular commercial bank has lent to bowling sector 42% of their total portfolio. Total portfolio, 42%. Now that bank virtually going to collapse because default of this NPAs are very high. Due to the security collateral available is low, value of the collateral has come down than the exposure to the credit, the high risk. Virtually that bank has under threat of collapse. Central Bank pumped 800 million rupees to that bank for the loan to come out from the difficulties. Over a period of time, just again the gold price are increased and the come to settle. But still, for all we have, any moment it can arise. Any moment it can collapse. Right. I'll give another example for this exposure risk. The recent past, another industry. We found that there's a high exposure has been risk. Now, prior to 2009, if you look at the central bank report, if I look at, prior to 2009, for the agricultural sector, we have lent entire banks, all the banks, lend only 2 to 3%. Less than 5%. And for the agriculture sector, all the banks have been lent less than 5%. Why? The risk is very high. There is therefore exposure to that particular segment was but most of the commercial banks are not came forward to lend to the agriculture sector. But that is the priority sector of the government. Agriculture sector is the priority sector of the government. Therefore, in 2018, government has imposed the minimum amount of 10% to be invested in the agriculture sector. If you are not invested 10% to agriculture sector, or whatever you less than that, the balance has to be put into a fund at the central bank. Right? So the exposure compulsorily given for 10%. That means all the banks should be able to absorb at least 10% of their portfolio for agriculture in case you default. Okay, the third risk coming from the credit is the recovery risk. Now, loan recovery, we have to recover our loan, and the loan installment getting defaulted, we take a risk mitigating instrument. We apply a risk mitigating instrument. One of the risk mitigating instrument is obtaining a collateral. Obtaining a collateral. That's a collateral for the security is a risk mitigating instrument to recover risk. But you may find even the collateral you take as a risk mitigating instrument have inherited risk. There are certain risks they are inherited in the collateral also. Therefore, banks has developed certain techniques to mitigate those risks. Right? Now, I'll give an example. It's a case, something happened a long time before. Now, we take collateral to mitigate the risk of default. But the collateral loss has inherent risk. Take in the case of a vehicle mortgage. Right? Vehicle mortgage. Now, for a loan credit facility, a vehicle was mortgage. Right? Vehicle is mortgage for loan facility. The loan facility was paying, so actually it's a Canter lorry, and the loan installments were paid regularly, but no default against motor vehicle. One night, this lorry went out of the road and knocked it inside the house and made severe damages to the house as well as some occupants in that house also. They also injured after this accident. The truck went out of the road, slipped out of the road and went into a house. Inside the house, there are some occupants inside the house. They were also affected. Now, for the investigation, insurance company came, called for insurance. They came. They looked for the insurance is the risk mitigating instrument for that asset. Any risk arises from the collateral, to mitigate the risk, one of the techniques was to get an insurance cover. So the insurance came to investigate about the accident. Right? And they checked everything, checked for the lorry also. They found that the chassis was damaged, and therefore they condemned the asset further not roadworthy. The asset is not roadworthy. Therefore, overnight, we lost the value of the collateral. Collateral value became zero. Okay, so what's the option you have available? We have no collateral, but insurance cover is there to cover up the value. So we have to put a claim from the insurance company to pay us the insurance coverage recover the loan. In the police came to investigation. Police found that at the time of the accident, driver was fully drunk. Driver was fully drunk. Now what is the situation? The insurance claim has been rejected. Now what is our bank's position of recovery of that loan? A collateral also collapse. There's no collateral now. If the customer defaulted, there's no collateral for us to recover. Okay, so that's why any movable risk arising out of any movable, to mitigate, we obtain two guarantors. In the movable, we take two guarantors because why? To mitigate the risk arising on the movables. Right? Well, so those are the credit risk areas and how to look at the credit risk. Right. Impact on non-performing advances. We continue with what are the important areas. We discussed firstly regarding the asset quality, material asset quality. We discussed secondly central bank guidelines regarding the capital requirement. Therefore, capital requirement. So, what are the importance of recovery? Right. What are the our business? We have risk of re-lending if it's defaulted. We get funds for lending for 5 sources: capital, loans, deposits, and recovery, and retained profits. These are the source of funds available for lending. Capital, loans, deposits are external funds. Are external from the institution, collect from the externally. Equity capital, loans, and deposits. Recovery and retained profits are the internal source of funds. Whatever recovered amount, put back to the cycle and given for as credit. That's called re-lending. It's a cycling process. Re-lending is a cycling process. We lend, we recover, and lend back whatever recovered amount. Capital as well as interest. So every time the cycle expands, portion of what you call interest also invested as in the business, so the loan portfolio is expanding. Now, right? Total capital, loans, and deposits are external source of funds. For capital, we have to pay dividends. For loans, we have to pay interest. For deposits, we get interest. As well, recovery and retained profits are whatever recovered amount can be invested back. So it's a re-lending process. And whatever retained profits can be invested back for lending. Those are the source of funds for lending. So if you look at capital, you have to pay dividends, loans you have to pay interest, deposit you have to pay interest. So therefore the first 3 are costly funds. Those are costly funds to generate profits, income, and spend and borrow the money. Whereas the recovery and retained profits are zero cost. Those are zero cost. So what is important for us to increase our profits? So it's going to expand the loan portfolio. Most important component is the amount recovered and the retained profits. All others are also increased where incur cost also. Okay. Recovery and retained profits are the important lending, what do you call, sources for lending, the funds available for lending. Okay, right. Make it sellable now. The second affecting to the profitability non-performing is profit deterioration. Whenever we write off the capitals, the customer unable to pay, we do the write-offs. Or sometimes when the customer not paid, we waive the interest. Right? Now these, and also according to Central Bank guidelines, we have to make provisioning. We have to make provisioning for NPA. But now the provisioning has been changed. Let us discuss next slide. What is the changes? Right? So the profit will be deteriorated when capital write-offs, P&L will be debited. Whenever interest is waiver given, interest will be reduced. When you do a provisioning, we debit the P&L and make the provisioning. So any of these actions will deteriorate our profit. It's affecting our profit. Therefore, we have to understand this provisioning part. We'll discuss in detail. What is the present position about provisioning? What is new circular about the provisioning for bad debts? Okay. Well, still a small break. We'll a small break and come back. Okay. We'll go out for a cup of tea and come back.
Okay.
Okay, right. Now, provisioning part, we'll discuss what is provisioning, but what are the provisioning regulations change in the past, from January, still under study most of the banks. Although Central Bank given this circular for 17 pages, step by step we had to study and see what are the corner points on this. Well, this is called classification, recognition, measurement of credit facilities in licensed bank. Right? This actually the Central Bank has given. As per the Bank Act Directions number 13 of 2021, Central Bank of Sri Lanka has issued the directions on classification, recognition, and measurement of credit facilities. In licensed commercial banks and licensed specialized bank. In the Sri Lanka Accounting Standard SLFRS 9, financial instruments and establishing consistent and prudent practices in the banking industry. These directions are implemented with effect from 1st of January 2022. That is on January. The new regulations have been come back regarding the NPA provisioning, and certain changes have been introduced. Before that, we had a guideline circular regarding the classification of NPA, non-performing accounts, and separately 2018 introduced employment regulations. Now, with these employment regulations and non-performing classifications are amalgamated and issued one circular, going as a one guideline. So there won't be any two provisioning, only one provisioning is coming up. Let's see what are these things. Now, basically, these changes, we have to understand why the government, the central bank has introduced this new one. Because under Basel regulations, risk classification, NPA classification has to be done under the FRS 9. FRS 9 is internationally auditing standard, accounting and auditing standard. Now, Sri Lanka Institute of Chartered Accountants has published this accounting standard FRS 9, where regarding the financial instruments and about the consistent and prudent practices in the banking industry. So therefore, most of the instances where we go through this circular guideline, we may find that they are, the central bank always directing to refer to the Institute of Chartered Accountants accounting standard document for any clarification. So therefore, it's that sometimes you may find some complex situations, some terms we may not familiar, and those are to be considered very carefully. Over a period of time only, these can be ironed off. Still, it's premature to discuss anything about that because only two months have left. Okay. Normally, whenever central bank is adopting this type of changes, they'll have a discussion or they have some sort of a program to roll out to introduce to the bank's staff about how to operate this one. But here, still we have not come across any such type of a clarification coming. Only the circular has been issued. Okay. The definition about credit facilities shall be on-balance sheet loans, and advances, which are measured under amortized cost or fair value through other comprehensive income and net investment in lease receivables. Okay, what is a credit facility? On-balance sheet items. What is appearing in the balance sheet? Right. Advances are measured under amortized cost. What is amortized cost? And all the terminology in the way. Amortized cost means outstanding balance. Loan, amortized means recovery after that cost. Amortized cost means outstanding balance, measured on outstanding balance or fair value. So new words come to the field. Fair value, what is the market value? What is the realizable value? Cost and the realizable value through a comprehensive income and net investment. Comprehensive income and net investment lease receivables. What is the investment net in the lease receivables? Okay, that's what. Now, very carefully see the wordings. Lease receivables, lease rental receivables, net investment in lease rental receivables. Therefore, there's no loan involved in the lease. These facilities are rental agreement and rental receivables. So net investment means what is invested by the bank or the bank, for the bank equivalent, what is invested in the bank, and net after what you call rentals have been recovered, what is the net position? Right? That's what called credit facility. So this definition is very somewhat all the terminology change will be very clear. Off-balance sheet asset. There is on balance sheet item which is appearing in the balance sheet of the banks. Off-balance sheet item means which are not appearing in the balance sheet. Okay. Balance sheet as including commitment to accept contingent liabilities. Commitment to accept contingent liabilities. Contingent liabilities, sometimes certain liabilities are once in a way it comes contingent liability, once in a way it comes. So it's off-balance sheet item which are not still created a liability. Right? It can be converted to liability in the future, including guarantees. Right? Including guarantees. That means that one of the examples that I can give guarantees. When you give a guarantee, it's an off-balance sheet item. Why? Because there's a liability is there. The liability is still making a claim. It's not becoming a liability. You give a third-party guarantee. Bank is giving a guarantee for a third party that the principal defaulted the terms and conditions. Whatever claim made by the beneficiary will be honored by the guarantor. That's a banker. When once these guarantees liability is to honor the guarantee. Once it paid, it's becoming a on-balance sheet item. Because already money has been gone out. Now it's becoming a on-balance sheet item thereafter. Bonds. Bonds also something like, and letters of credit. These are letters of credit we issue. Once it has a acceptance or the letter of credit has been paid, then it's becoming an on-balance sheet item. Right? Letter of credit is a what do you call a fee-based product. We discussed the credit as a fee-based product. Also, under the letter of credit, if a loan is given, TR loan or hypothecation loan or pledge loan, then it's becoming a direct liability. And such times called a contingent liability. Then acceptances. Acceptances mean to pay on the future date. So this comes at tenor bills mostly. When tenor bills mean or users bills, the acceptance to pay on a future date. Right? Till it paid, it is spending. It's called a contingent liability. Then undrawn commitment, component of the credit facility, such as credit cards and overdraft facility, etc. This is a new what you call interaction. Undrawn commitment, undrawn component of the commitment component. That means credit card, there's a limit for a customer. We are given a credit card limit. But customer not utilized in full limit, entire limit. A part has been utilized. So the balance part is a contingent liability. For example, customer has given credit card for 1 million. At a given time, we are utilized only 500,000. Right? So the balance 500,000 is not used yet. Any moment can be used. Any moment it becoming a liability. When it is used, it's becoming a liability. So it's a contingent liability, means it's not being used yet. Also overdraft facilities. Overdraft facilities are referring to permanent overdrafts. Permanent overdraft, we are giving a limit and customer is utilized under the limit, the different. Any moment it can be converted into a direct facility. So that's called contingent liabilities. That's how the definitions have been detailed. So that we carefully understand what is a on-balance sheet facility, what is the off-balance sheet liability, on-balance sheet liabilities and off-balance sheet liabilities. Whatever on-balance sheet liability which is appearing in the balance sheet, off-balance sheet item which are not appearing in the balance sheet. Okay. Now sometimes you may find certain accountants in the financial statements, there's lease agreements are incorporated as in the liability side, asset side, as a receivable. Okay, So when it appearing in the lab as a liability on this side, receivable, on the other side it should be shown as an asset. So normally lease and high purchase is a debit, therefore it can appear as a loan, but a lease is a off-balance sheet item. But for some of the banks, some of the accountants shows as a in the balance sheet. It's not correct. Okay, it's not a accounting principle, right? Then the borrower shall include individual companies, the government of Sri Lanka, public corporations, statutory bodies, other firms like partnerships, state-owned entities, right? Sometimes you get companies under the public companies owned by the state, then association of persons of any other entity, any business entity. So it's called who is a borrower, to whom you are your facility. The classification on credit facilities are licensed bank shall classify all credit facilities for purpose of impairment assessment. This the word comes, impairment assessment. Classify credit facilities for purpose of impairment assessment, risk mitigation, and monitoring into performing and non-performing loans and advances as follows. And monitoring into performing and non-performing loans as follows. Performing credit facilities mean all credit facilities classified as stage 1 under SLR refers line. That means performing credit facilities. See, I told you earlier, central bank was not giving directly what should be there, where to refer institute chartered accountants document for any classification. What is a performing credit mean? All credit facilities considered as stage 1 under SLRFS 9. Performing credit facilities. So you can understand this terminology, performing credit facility, because of that we understood that. Otherwise, we have to refer the SLRFS document, what is stage 1 classification. And all performing classifications are number 1. 2, all credit facilities identify significantly increased credit risk facilities and classified as stage 2 and SLFR 2 underperforming credit facilities. Now, make clarify items. Okay. So the performing credit facilities mean or performing credit facilities and credit facilities which are increased the credit risk and classified as stage 2 and SLFR underperforming credit facilities. Okay, underperforming credit facilities. We're also calling as stage 1 and stage 2. Non-performing credit facilities is all credit facilities per major performing credit facility current regular section underperforming 1 to 3 installment in arrears. 1 to 3 installment arrears. 90 days පවතිලා නැහැ. හරි. කලින් මේව තිබුණේ කොහෙද තිබුණේ? Regular section එකේමයි තිබුණේ ඉස්සර. It was there in the regular section earlier. Now it has been segregated to a separate stage called stage 2, underperforming credit facilities, where 1 day to 89 days in arrears before transferring NPA. Second classification is non-performing credit facilities mean all credit facilities where contractual payment of customer pass due more than 90 days. The number of days past due shall be calculated starting from the contractual due date of the payment or 90 days from the payment due date. Sorry? The facility where contractual payment due date is payment due date is 90 days then non-perform beyond 90 days. Then so has remained in excess of sanction limit for more than 90 days. Overdraft. specifically overdraft, sanction limit exceed Kaladina. I mean, excess of sanction limit more than 90 days. That was a non-performer. And any other credit facility is classified as a stage 3 credit facility under SLRS 9. Facility cover NP non-performing credit facility based on potential risk and impaired assets on the origination. Now, these two has to be identified. What is this? Stage 3 credit facility under SLFRS 9. Facilities classified as non-performing credit facilities based on potential risk, probable risk, and impaired assets at origination. So impaired assets mean which has been, although in the regular section, you anticipate a loss. Anticipate there can be a loss. So that's called, we do impairment that we discussed earlier. What is that? Right? Okay. The licensed bank shall not consider the value or type of the security obtained by the bank against their credit facilities when determining the classification state of the credit facility. Now, this is a different change from the former system. The former system, we consider the value and type of security obtained by the bank when classifying the state of the credit facility. Right? Value of the credit facility, the security, and the type of the security. Movable property, movables, right? Tangible, intangible, like that. We have classified different types of securities. Now, that's not considered for now, present situation. Earlier, we considered the value of the collateral, right? When you make a when the Basel regulation is introduced, what is the risk? Credit risk. Credit risk defined as outstanding balance minus realizable value of collateral. Realizable value of collateral. Right? Now that classification no more valid according to new regulations, new guidelines. The security is not considered. Not all considered whether security is realizable or not. That was considered when you doing the classification. In cases where the borrower has several current accounts with overdraft limit with the bank, the aggregate sanction limit and the daily outstanding aggregate balance on all such accounts shall be considered for purpose of consideration of overdraft. So overdraft means if a customer having more than one account, if one customer having more than one account, where different limits. So aggregate means total and all the outstanding balances and the sanction limit. For one account, you say 1 million, the other account 500,000, the other account 2 million, total 2.5 million total aggregate sanction limit. So each and every account, what is outstanding balance? So that has to consider for the classification of outstanding. Right. What are the staging of credit facilities? First stage, he said, performing. Stage 2, credit is significantly increased. Stage 2, credit impaired. Right? Net impairment. The financial assets are performing. Credit is significantly increased. Credit impaired are stage 3. Stage 1 is performing. What is performing? Last slides we discussed what is performing. That is regular loans, right? Performing means regular loans, and also which are the stage 2. This is also coming under performing. Credit is significantly increased. Stage 1. Then loss allowances are 12-month expected credit loss. Stage allowances for the stage 1. Expected credit loss 12 months, right? Life stage 2 again, lifetime expected credit losses. Lifetime expected means total amount will be made as allowance. 100%. Similarly, for stage 3, lifetime means 100%. Here only 12 months expected credit loss. Okay, this is the problem. How to calculate this expected credit loss is problem at the moment we are facing. So bank to bank, we have different criteria have been adapted now. So let us see the Panela guideline for this in the future. And the interest revenue on gross carrying amount. Stage 1, on gross, the carrying amount how much? Similarly, stage 2 also on gross carrying amount. Stage 3 at amortized cost, whatever recovered. And balance will be the interest revenue. So staging of credit facilities, how to do the classification, stage 1, stage 2 and stage 3 facilities. Then this, we talk about the significant increase, stage 2 credit risk significantly increased every year. What is this? For the purpose of calculating lifetime expected losses under SLFRS 9, at a minimum, if one or more of the following factors, conditions are met, it shall be considered as a significant increase in credit risk or as defaulted facilities. Stage 2 a significant increase in credit risk defined contractual payments of a borrower are past due for more than 30 days, subject to rebutable presumption unless SLFR 9, 90 days. Past due more than 90 days. That is, you know that NPA transferring to non-classification, what do you call, non-performing is 90 days. So more than 30 days, up to 89 days, payment arrears are considered as significant increase in credit risk. Right now, this particular case, I was discussing earlier classes about this one. Now, you have a loan installment due for day, right? It has not been recovered. On very first day, it is fall in the risk. Now, under this classification, after 30 days only considered as a risk increasing. That means within 30 days, we are not taken any action to recover that loan installment. That's a credit risk. That's not the idea behind. SLF say that. SLRF says presumption is if you are taken any action before 30 days, before next installment falling in due, you can do the recovery. That's accumulating. After 30 days, second installment was fallen due, then it is becoming credit risk is increasing. Now earlier, this component is there in the regular section. It has not been looked into carefully. But when impairment regulation was introduced, only this area has been paid attention. Otherwise, when we know all these days up to last year, up to 31st of December 2021, what is an NPA ratio we calculated, what is the non-performing advances in the accounts which are transferred to NPA, and right, to percentage to the total advances. So there's a component in the regular section which are not paid. This is due to falling in arrears. Similarly, there's another one item I forgot to mention earlier. Certain fixed assets also, fixed assets. That means after mortgage action or a parent action, when there's no buyers, bank has to buy. Now, bank has to buy at market rate. That's the central bank guideline, right? And to buy at the market rate, and it's appearing in our fixed assets. Now, that component is not considered as NPA in our calculations. Now, under this impairment regulation, that also has to be considered for making provisioning. Okay. Credit rating of a borrower has been subsequently downgraded to B plus or below on Sri Lanka national rating scale by external credit assessment institution. So this is what latest addition. I don't know if you are aware of this. 2020, they want to introduce this credit rating by the central bank. I don't know if you are aware of this. A new the scheme has been introduced by the central bank that called credit score. Right, this national credit rating scale is called CRIB score. According to this introduced to apply from August 2020, but unfortunately due to the corona or implementation position, it has not been launched yet. So in the very close near future, this rating scheme will be introduced to the banking. So all the bank can use any national identity card number, and you can get what you call rating from the central bank. But central bank actually this CRIB, under the CRIB it has been established rating scale. Now this rating has any rating agency have given a B plus or below, that call a significant increase in credit risk. The borrower has subsequently downgraded to B plus or below, so that is called an increase in credit risk. So there are two things. One is payments are more than 30 days, and also the credit rating has been come down below B plus, also significant credit risk, considered as a significant credit risk. A two-notch downgrade under the internal rating of the licensed bank. If a licensed bank, if it is a licensed bank, their rating has come down, and there's a significant credit risk here. Licensed banks are required to map their internal credit risk rating with the rating issued by the ECA. For this purpose, licensed banks are required to refer mapping of internal credit rating given by the banking direction on the capital requirement. Right? So we had the banks have to work out on their directions to see if the bank has been downgraded. The bank has been downgraded. Reasonable and supportable forecasts of the future economic condition show a direct negative impact on the performance of the customer group of customers. The fourth one is reasonable and supportable forecasts of the future economic condition show a direct and negative impact on the performance of a customer or group of customers. If you see, that also considered for significant increase in credit risk. So four areas we already discussed. A significant change in the geographical location or natural catastrophes that directly impact the performance of the customer group of customers. Any change in the geographical location which is have an impact on the customer's performance. The value of collateral is significantly reduced and or reliability of collateral is doubtful. Licensed banks shall define relevant threshold limit and document the same. And next one is the value of the collateral significantly reduced. Increase in credit risk. Collateral is taken, the value is reduced or doubtful and unable to value due to the valuation, the collateral, then they are also increasing credit risk. The borrower is subject to litigation and significantly affect the performance of the credit facility. Borrower is some sort of a legal action against him. Some sort of a legal action against him. And will significantly affect the performance of the credit facility. If a customer has to go file action against him for some reason, then he had to service first that expenses incurring on the litigation. So what will happen? Definitely he will default half a cent. Right? Therefore, that also significant increase in credit risk. Frequent changes in the board of directors and senior management of an institutional customer. Any, what do you call it, board of directors or senior, if frequent changes, that means there's a the dispute among the board of directors and the senior management. Right? If there's something like that, it will definitely affect the performance of the customer. Now, for example, frequently factory managers are changed, frequently quality controls are changed. Their board of directors, some directors are already appointed, but they are not accepting the position. They may absconding board, board meeting. So that is some problem in the management. So that also lead to increase in credit risk. Then delay in commencement of business operation projects by more than 2 years from the originally agreed date. Due to some reason, commencement of business operations more than 2 years, that also increasing credit risk. Modification of terms resulting concession, including extension, deferment of payment, waiver of covenant, etc. Okay, changing of modification of the agreement where the concessions are considered, including extensions, deferment of payment, waiver of covenant, etc. Okay, significant changes. When the borrower is deceased or insolvent, the borrower is deceased or insolvent. That means insolvent means if I file action against the borrower that his assets are not sufficient to meet the liabilities. In such instance, court will decide that that person has been insolvent, bankrupted. Such instances also the risk increases, credit risk increases. And borrower deceased means there's contract between the borrower and the banker. What will happen? It will ceased. So definitely it will have an impact on risk. Licensed bank is unable to contact or find the borrower, and right, sometimes this is a very common factor for us, unable to contact or find the borrower. If the borrower, all the letters sent to the borrower is returned undelivered, reasons of giving. Or sometimes if you go to his place, no, they're not there. Sometimes you have vacated the place and gone somewhere else. So you may not be able to contact him to do correspondence. Again, same instance, the risk is increased. A fall of 50% or more in the turnover and the profit before tax, the borrower when compared to previous year or two, consecutive years, and for erosion of net worth of the borrower more than 25% other than the due changes in the equity structure and dividend policy when compared to the previous financial year. If any business turnover have declined more than 50%, that means the sales have declined more than 50%. Or net worth is the capital. Net worth is deteriorated by 25%. How the net worth, capital can be erosion? How the capital can be erosion? By losses. If the losses adjusted the capital net worth will come down. Any losses, continuous losses will erode the capital. It's called that's a net worth of the borrower. The restructure regional credit facility as per the guidance provision in the Direction Number 10. Here we discuss restructure regional fellow programming, I will discuss. Okay. Then again we are going back to the subcategorization of non-performing credit facilities based on number of days past due and based on potential risk. Now this is somewhat we had earlier. Same thing is again coming up. The subcategorization. Now we had got stage 1, stage 2, stage 3. In addition to that, facilities has to be categorized: special mention, substantial, doubtful, and loss. Now this is the earlier what you call manual earlier system. It will be applied same, but there are some changes in the risk and the number of days in past due. Right. What is special mention category? More than 90 days, but less than or equal to 180 days. Here, same thing what was earlier. 90 to 100 days, special mention category, based on the number of days. Then based on the potential risk, all credit facilities exhibit potential weaknesses where, if not corrected in timely manner, may adversely affect the repayment by the borrower at a future date, and those warrant close attention by the bank. This is called potential risk. Okay, now that is the difference between the early system and new categorization. Earlier, the potential risk was based on the collateral. If there's a collateral available, minus outstanding balance minus collateral, we take as the potential risk. In other words, earlier, risk, one of the risk identifying category was the availability of collateral. So we already discussed, I mentioned that. Now, no more it is appearing collateral. Now, what is the potential risk? But this is SLFR gives the cash flow. Now the risk is based on the cash flow. Right? Number of days and the cash flow. All the credit facilities exhibit potential weaknesses. We are not corrected in timely manner. May adversely affect the repayment by the borrower. This is the cash flow. That is it. Repayment by the borrower at a future date. And those warrant close attention of the bank. So that need a close attention. Special mention. So 90 days nothing will not. If this is not less than 90 days, even that this make apply honor, it has been transferred to special mention category. Okay. Then the substandard category, more than 180 days, but less than 270 days based on the number of days. Now let's see what is the potential risk. All credit facilities are the exhibit definable weakness. This potential weakness, this is definable weakness. Weakness is specifically exhibiting, showing them. Either in reset of business, cash flow or financial position of the borrower. Right? If any weakness showing in the cash flow or financial position of the borrower, that means if you do a cash flow projection for the customer, it shows a deficit right throughout. Sure, deficit right throughout, that is a definite weakness of the customer. That is high. Income is not sufficient to meet the expenses. Inflow is not sufficient to meet the outflow. So that's called financial position of the borrower. That may jeopardize the repayment of existing terms, and where there is uncertainty, that part of or the entire facility will be repaid or involves more than normal risk of loss due to unsatisfactory debt servicing record, financial conditions of the borrower, insufficiency of collateral or any other factors which give rise to some doubt as to ability of the borrower to comply with the present repayment terms. Right. Secondly, anything affecting the repayment. Earlier we discussed potential repayment, potential weakness and repayment. Here, exhibited definite weaknesses on repayment. Kevagal berry vidiate cash flow alvila that is substandard category transfer. In doubtful category, so 270 up to 360 days as per normal past due number of days of outstanding. Potential risk is all credit facilities exhibit high risk of partial default or where full collection is impossible. संपूर्ण न्याय आय කරගන්න හෝ කොටසක් ආය කරගන්න බැරි තත්ත්වයක් පෙන්වනවා. And that there is high risk of default where the outstanding credit facility exhibit more severe weaknesses than those in the substandard category. Severe weaknesses than the exhibit definable weakness. It's a very that means exhibit high risk of partial default. Full collection is impossible. That's a doubtful. In loss category, more than 360 days, all credit facilities deemed to be uncollectible or are almost certain that such will not be repaid and which are categorized as non-performing credit facility but not included under special mention or subset of the doubtful category. Deemed to be uncollectible. That is completely customers' money cannot be recovered for any reason that will be considered as a loss category. For example, if a customer dies, it is loss. That is considered as a loss category. Okay, so new regulations implementation. Today is the first session I am doing in this new regulations. So I try to maximum try to classify, clear you about the new regulations about the classification of advances. Right. Now the important thing is before you put that, let's see. So, provisioning part is not clear how much the categorizing part is there. How to make the provisioning still little not clear. Only one instance given where the special mention regular categories 0.5% provisioning is still there. Right? In Yahata provisioning substandard doubtful loss category, provisioning about the provisioning part is still not clear. It's there in the annexure, but like they are mentioned in the guide directions, this is the annexure. But I tried to find out in the annexure. Annexure was not there attached in the published one. So I spoke to some banks also to try to get this annexure. Let's see. Okay, right. Now, with this new classification, the impairment regulations are coming into force. Earlier, we had impairment regulations from 2018, it was there. Let's see what is this impairment. Impairment is an accounting principle that describes a permanent reduction in the value of company's asset, normally fixed assets. Is an accounting principle. Impairment is accounting principle, which is I guess always chartered accountants are involved in this. The accounting principle regard the permanent reduction of a value of company's permanent reduction, and for that has to be what you call impairment provision has to be made. When testing for impairment, the total profit, cash flow, or other benefit that expected to be generated by a specific asset is periodically compared with the same assets book value. Right? When testing for impairment, testing how to do the impairment, that will be based on the profit, cash flow, or any return generated by that asset compared with the same book value. Right? If it's found that the book value is of the asset exceeds the cash flow or benefit of asset, the difference between the two is written off and the value of the asset declines the company's balance sheet. Okay, so benefit, what are the benefits given here? It is less than the book value. Book value is more, realizable value is less, then the difference has to be written off in the profit and loss account. And the asset declines the company's balance sheet, asset will be declined. Do the write-offs. Impairment is specially used to describe a reduction of an amount which fixed. Specifically used to describe a reduction of the recoverable amount of a fixed asset below its book value. Specifically used to describe a reduction in recoverable amount of the fixed asset below its book value. Book value එක කියන ඊට වඩා අඩු නම් realizable value එක, the difference has to be made provisioning. Okay, right. Now I'll give an example for this to understand. A little while ago I told you regarding, we do a parade for immovable property, we do a parade. When we do a parade auction, parade is taking the possession of a immovable property by the board of directors of a bank without referring to courts. That's called parade. And after taking the possession of such asset, will be sold in public auction to recover the value. When you put it in public auction, if there's no buyers, right? If there's no buyers, then what will happen? Or buyers are offering lesser than the upset price. There's no buyers, or buyers are offering less than the upset price. At least upset price or more, you have to sell. Right? That property has to be bought by the bank. Bank has to be done by. If there's no buyers, bank has to make offer and buy. Now, what is the offer bank has to be put? Is this more than the upset price? How to fix the upset price? Central bank guidelines given. Upset price to be fixed using the market value. Where I take a valuation report and get the market value, and you place the market value, not the loan value. It is not the loan value, it is the market value. Okay, so you buy at the market value that property, bank, and you set off the mortgage. Customer liabilities no more there. Okay, now that particular asset, property, appears in your balance sheet in your fixed assets. At what rate? At market rate. Okay, so your book value has increased because of the market. But actually realizable value, when you try to sell that particular asset, although market value is that, because you are selling in a forcible value, actual value will be always less than the market value. When you go for a forcible sale, they are selling by force, no? Right? In a forcible sale, most of the time, the amount market value will not be realized. Tell us that. So the difference has to be a loss. As a loss, it has to be make provision in the impairment regulations. Understood? It has to be impaired. Impairment normally occurs when there is a sudden and large decline in the fair value of an asset below its carrying amount. or the amount recorded in the company's balance sheet. Whatever balance in the balance sheet, take a balance out of fair value, it has to be impaired. Okay, right. Let us see the Central Bank guidelines. Other than the guidelines issued by Central Bank of Sri Lanka, the accounting standard IFRS. Now see the word used here, IFRS by Central Bank. IFRS, International Financial Regulation, is coming in 9. So same thing is now adopted by SLFRS. Okay, in Sri Lanka. Require banks to impair financial assets, the guidelines accounting standard, according to the IFRS regulations given by the Basel. Banks has to impair the financial assets. Impairment assets to ensure that the entity's assets are not carried at more than its recoverable amount. Okay, that means you have to adjust the balance of the fixed asset to the realizable value, recoverable value. If it's more than that, that the difference has to be impaired and divided to the P&L. So it will be affecting the profitability of the bank. Okay, except for goodwill and certain intangible assets, all other assets must be impaired. When the carrying amount of an asset exceeds its recoverable amount, that asset is impaired. Book balance recoverable amount of impairment test is to ensure the assets are carried on no more than their recoverable amount and to define how the recoverable amount is determined. Recovery test is ensure that assets are carried no more than the recoverable amount. You can book value recoverable value samanam into to define how the recoverable amount is determined. So the recoverable amount, how you are determined, that's the question. What's the actual recoverable amount? When analyzing loans and recoverable for impairment purposes, individually significant financial assets are assessed individually. Individual, not significant assets are assessed collectively. What do you mean by these two? Earlier I had discussed this about what is individually significant and collectively. I used two different words. It comes in IFRS, it's called individual significant and collectively significant. I use the practical term for this. Yeah. In the portfolio risk, we need to discuss about the portfolio risk. That is the risk of the portfolio or the portfolio exposure risk. When you discuss exposure risk, I told individual significant means particular customers, one particular customer's risk. When analyze loan for recoverable for impairment purpose, individual significant means one particular customer's asset, the loan value and the realizable value is different. Realizable value is lower than the loan value, then the loan value has to be adjusted according to the realizable value. Financial assets are individually and collectively means portfolio. Entire portfolio loan value is given, so the value is collectively should be impaired if the total exposure will be taken into consideration by impairment regulation. So individual significance for the individual customer, collectively means total exposure of that for a particular segment. In terms of SLFRS 9, debt instrument shall pass the SPPA test. Contractual cash flows mean solely payments of principal and interest. SPPA means solely payments of principal and interest. Instrument shall pass the SPPA test. That means all the debt instruments means all the credits has to go through principal and interest. If so, such instruments shall be classified as financial assets as amortized cost. Hmm? So shall be defined as amortized cost. That's been whatever recovered amount minus outstanding balance. We call amortized cost. Or finance assets that fair value through other comprehensive income, if fair value other comprehensive income based on the outcome of the business model test. And there are two types impairment of the classified method introduced by the SLRFS. One is cash flow method. Other one is financial fair value method. Okay. Cash flow method, fair value method. Cash flow method is used, principal amount and interest can be recovered as amortized cost. Fair value mean that the comprehensive income is sufficient to recover or the set will be matched the value of the assets. Licensed banks are required to maintain standardized process, detailed checklists and decision trees in order to assess and identify the SPPI features of their products and contracts. This is a difficult part given to the banks. Okay, the impairment exercise is an analytical process, and the persons involved in the exercise have to use their own judgment using objective evidence. Right? The persons involved in the exercise have to use their own judgment using objective evidence. So that's the directives, guidelines were not specific. Bank to bank, it may vary. Because to use their own judgment using objective evidence, bank to bank may vary. Okay, so what is the decision process? Analytical process. Decide if the loan is individually significant. Decide if the loan is individually significant. Is there collective objective evidence of incurred loss? Collective objective of evidence of incurred loss in the past. Is the loan carrying a value greater than the estimated future cash flows discounted at EIR? No? Future cash flow discounted and see. Discounted cash flow is optional, what is it? And see whether the value can be recovered. Quantify and raise collective impairment provision. Individual significant, collective එකතු කරාට පස්සේ finally collective impairment provision කියන්න ඕන. Okay. So what is individual significant loan impairment? Banks to determine an internal threshold to assess credit facilities individually to identify whether there are any other objective evidences of impairment. Individual. Internal threshold, assess develop a threshold, assess the credit facilities individually, one by one. Factors indicating SR, significant impairment, are considered as objective evidence of impairment. If objective evidence as an impairment exceed, the facility shall be classified in stage 3. Okay. If objective evidence are impaired to exceed, then the facility has to go to stage 3, that is non-performing loan. Thereafter, determine relevant loss of default, cash flow forecast is done. Cash flow, amortized cost. Cash outflow, amortized cost. Cash inflows, expected recoveries through repayment and or realization of collateral. Cash flows are converted from future value of the present value based on the original effective interest rate of the credit facility. So the cash flow has to be calculated taking into consideration the interest rate, original interest rate of the credit facility. If net present value of the cash flows are positive, no individual impairment is maintained. However, facility will be remaining stage 3. NPV is positive, then still the loan will be in the stage 3. If the negative NPA is derived, such amount is paid to the individual impairment charge of the facility. Okay, so an NPA is negative, that amount will be debited to the P&L. If objective evidences impairment do not exceed, then the facility will consider for collective impairment. Okay, individual ones are not individually impairment is not collective evidence. If the evidences are there, then the facility should go to collective impairment. That is not individual impairment. Collective impairment means the credit facility is not assessed on individual basis, will be considered therein. Right? The credit facilities are segregated into homogeneous portfolios. That all portfolios into one category, like the housing loans. But it can be different housing loan type, but homogeneous. Based on the characteristics of products, type of collateral. The probability of default, PD, will be computed for stage 1 and 2 separate for each portfolio. Right? Collective impairment, default PD, stage 1 and 2 separate for each. The probability of default of stage 3 facilities are considered as 100% as those facilities are already defaulted and impaired. When it comes to stage 3 facilities are considered 100% considered as 100% default. Then LGD, loss given and default, will depend on the recoverability from the customer's repayment and or realizability of collateral. Economic loss given facility will depend on the recoverability from the customer's repayment and realizability of the collateral. Either from the repayment or realizable security collateral, loss given default can be recovered. Economic factor adjustment will account for factors such as GDP, inflation, exchange rate, interest rate, etc., etc. All environmental factor will be adjusted according to the listing. Then impairment loss provisioning as per CLFRC consider shortcomings in the base probability of default model or collective overall from transfer agreement. So that means ECL is probability of default, 12 months period probability of default, and transfer criteria is 12 months of probability of default or lifetime probability of default. So we discuss what is these two. 12-month period for impairment to first part, stage 1, stage 3, 2 and 3 are lifetime PD. Into life GD into EAD into overall outlay. The potential adjustment for forward-looking forecast, overall station, etc. So this is a process of impairment regulation. Okay, right. So that's about the new regulation related to the provisioning for NPA provisioning and impairment regulations. Let us discuss a little more on impact on non-performing versus what is the impact of NPA to different transactions. Effect on pricing. What is the effect? How the effect on pricing? How do we pricing our lending products? There are two methods we use. One is called CD ratio method. Other one is cost of fund method. CD ratio method and cost of fund method. CD ratio method is applied by the non-commercial banks. Non-commercial banks, that is finance companies, specialized bank, they apply the CD ratio method. That means credit deposit ratio. Now, for example, you take a 1 million credit deposit at the rate of, you say 8%, 1 million FD, fixed deposit or term deposit, for a period of 12 months at the rate of 8%. Okay. Now, end of the year, 12 months, 1 year, you have to pay the customer 800,000 for 1 million. You have to pay 800,000. To pay this 800,000, you have to earn. To earn, you have to lend this money, 1 million. You have to earn, lend. At what rate you have to lend? Okay. So if you look at this entire 1 million, can we give? There are certain provisions we have to leave out. One is strategy regulations. That is how much the what do you call cash rate, what do you call it's not strategy, that's called security position. We have to remain certain amount in hand. That is about the 20% of the total deposit has to be retained in for emergency. Then cash payment for 5%. About 25% you have to retain. Okay, minimum. And also sometimes default premium, we had default premium and all. So if you had that also finally, if the default premium is 5%, then 30% of the deposits has to be retained. So only 70% of the deposit, that is 700,000 only, you can invest. For 1 million, only 700,000 can be invested. So you have to invest 700,000 to earn at least minimum of 80,000. At what rate you have to give? You calculate and see what is the rate. So that's how the pricing of our lending products, basically. But the commercial banks apply the most common methodology called cost of fund method. Our bank commercial cost of funds, there are two components. One is financial cost of funds. Other one is administrative cost of funds. Financial cost of funds means the total interest paid for the depositors. Total interest paid for the depositors are called financial cost of funds. So your bank will calculate in their P&L interest paid for savings, fixed deposit, and all the interest payments divided by total deposits. What is the percentage? So bank to bank, it may differs. Branch to branch, it may differs. Depending on your deposit mix. So the deposit mix is the deciding criteria about your cost of funds. In the bank structure, if you have more demand deposits, less savings and less term deposits, you have a very small, low financial cost. If you have a high demand deposits, low demand deposits, high savings and term deposits, then your cost of fund is going up. Again, the rate of interest given for savings and term deposit also have an impact on the cost. Right? So cost of funds are directly, the financial cost of funds are directly the interest paid to the deposits. So any bank having more savings and term deposit than demand deposit, that bank have a high financial cost. Any bank having a higher balance of demand deposits and compared to less savings and term deposit, that bank will get the benefit of the cost of funds. In deciding the price, those banks can give a better rating for their advances. The next one is administrative cost of funds. It's common to all the banks. There are two components again. One is non-interest expenditure. Salaries, administrative expenses are non-interest expenses. Other than that, in the P&L, profit and loss account, there are some more items. The capital write-offs, interest waivers in impairment provision of NPA or impairment provisioning. Impairment provisioning. And add these together, total administrative cost, you can get it. So if you divide it by the total deposits, you get the percentage on administrative cost of funds. Now adding these two, financial cost of funds and administrative cost of funds, you determine total cost of funds. Okay. Now, if you take the average industry norm, total cost of funds, for example, at present 10%. Now, recently, yesterday, central bank requested banks to increase the interest rates. So, cost of fund will be, financial cost of fund will go up. Right? So, we say 10%, for example, total cost of fund is 10%. Now, when you lend, there adds what you call risk premium or profit margin. Say, you say 3% risk premium, 3% at Karaman, 10 now 13%. So you have to go at the rate of 13% for advances to become break-even level. But thing is, you may not be able to recover 100%. When you practice, you see your default rate is about 8 to 10% once again. For example, if you say default rate is 5%, is more than that now. Huh? So default rate is 5%. So you can recover only 95. So now cost of funds you are given as 13 divided by 90, right? And multiply by 100. What will be the cost interest rate? Okay, that is 13% divided by 95 into 100. That is 13.68%. Okay, so if you're given at 14%, you are at break even. No loss, no profit. So you have to give beyond that. That's how we calculate the interest rate on our lending. So if you're given at 14% or more than 15% or 15%, we can survive by lending. You can survive by lending. This depends on your recovery. So when your NPA increases, the rate is going up. The expenses are increasing, the rate is going up. The NPA is going up, your rate is going up. Cost is going up. Right. Now, for example, if we say 14%, example, loan is given at further 14%. Now, who pays this 14% interest in your bank? Which customer is paying that? That's the regular customers. Regular given at 14% given. 40% given regular customers. Right? They don't know how we have calculated. So they, without doing this, we pay. Now actually, you're provisioning for NPA. Your non-performing advances, certain may impairment or is impairment. The provisioning also incorporated in your PL as expenditure. Part of expenditure, the NPA provisioning also there. Okay. Now, who pays for your NPA? Who pays for your NPA? It's the regular customers. The rate of 14%, part of which incorporated administrative cost of fund, which is where provisioning was added. So in other words, our NPA provisioning and capital write-offs, interest waivers, also part of our expenditure we added in customers, good borrowers, they will be paying our sins. They are paying our sins. Now this is called transfer pricing system. How we shift our cost to the price. The customers who knows about this, they are demanding for a price. Customers have AW LR plus 2%, 3% money customers provide. Provisioning part add kara, then now your customer will be paying for that. Now, if you look at 70% of your current account customers are business customers. 70% of the customers are business customers. They borrow from the bank loans and you charge interest on the loan. So interest rate is 14%, for example. Okay, so customer is paying that. Now the customer, for 70% of the customers are business customers. And they will add their financial cost into the cost of goods or cost of services. They'll add this financial cost into cost of goods or cost of services provided by them. Now who pays your NPA? Now who pays NPA? It is the general public. What's the impact on that? Due to an interest rate, the inflation may go up. The more the interest increase, more the inflation goes up. That NPA of banks are no more an internal factor. It's a national issue. It's a national issue. That's why government always, central bank always trying to control this area because it will have an impact on the economy directly. Bank lending layer rates are directly mapping, applying to the economy as price index is going up. Okay. So what are the direct impact on this? Finance institutions hold land and properties and other collateral of the businesses that have failed to service more than 100 billion US dollars, $1 billion US dollars. I told you, your mortgages, property mortgage, if a default, the parent does not success, bank has to buy. Once the bank bought, it will be appearing in your balance sheet. So according to central bank report, value of such properties were a long time before, about 100 billion, is more than that now. Nearly 2 billion US dollars are held in our books without generating any income, or those resources are utilized to create and foster growth in the economy. Again, practical cases are there. Okay, so big impact on it. I want to remove this, but still for all it's worth to understand. This happened in 2007, long time before, but the concept is still valid. HSBC Sri Lanka's asset base, though strong by Sri Lankan standard, weakened in the years due to increased delinquencies on credit card advances, residential housing loans, loans to medium-sized corporate segment. It's happening at the macroeconomic recession time, 2007, 2008. The bank has since tightened its credit card underwriting standard in consumer banking and credit cards in particular, and increased focus on the collection and recovery during the latter part of financial year 2007. I got this from a fish rate in Sunday Financial Times, Sunday 10, 2000, August 2008. It was published. What is what gives you this information? HSBC. HSBC's asset base, that is the NPL, affected due to the delinquencies on credit card, residential housing loan, loan to medium-sized corporation. What is HSBC's business? They are focusing on a specified clientele group. They try to come down for the retail market. What has happened? They lost. I still remember 2008, I was in Nikambo, I think, yeah. I was traveling to Nikambo in Mantala Junction. HSBC put up, canopies and selling credit cards. The criteria of giving us a credit card also is a lending product. Without an evaluation, no credit can be given. No credit should be given. Whenever you see the credit cards they issue just left or right without any evaluation. I have a number of cases about the HSBC as well as other banks. They issue credit card without any evaluation. One of the cases recently brought to me by the HSBC, the credit card given to salesman. Salesman of a shop given a credit card. The credit value was 250,000. It has defaulted. He says, the cardholder says that he had returned by the card, but HSBC has not closed the account, cancelled the account, and keep on debiting the interest, penalty fee, and surcharges, everything. After 5 years, this 250,000 has increased to 1.2 million. And bank won't file action against him, this person, to recover. What is his position? He's a salesman in a shop. Understand the gravity of it. So it is credit card also a credit. So it evaluates the repayment ability of the customer. I take this because of that, to understand that if you let loose of credit, you will end up in disasters. In 2008, highest default rate in credit cards was reported by HSBC in Sri Lanka. Okay, so you understand that what type of credit you have. Who is responsible for default? Customer or the bank? How the policy is? Customer, the bank. We had a research in 2006 by the central bank, selecting about 1,000 defaulters from the various banks. The research was to find out why the reason for default, why make the default. So the research report findings was very serious. Although we tell that customer is a default, customer is making default, but we found 68% of the default are due to bank's fault. The banks have put customer in a difficult position and customer defaulted. So bankers are responsible for the default. Only about 5%, what do you call willful defaulters? Defaulter, willful defaulter, only less than 5%. So we individually interviewed these willful defaulters. Given the pull Gapulatia, given Hakia, Tiedi Gapulatia. In this interview them. One of the given Global මහත්තයෝ මම ලෝන් එක ගන්න ගිය වෙලාවේදී මට දුන්නු වදේට මම දැන් දෙන උන්ට මං ගෙවන්නේ නැහැ පුළුවන් නම් අනුසලාය කරගන්න කියලා. It's the gospel truth about the willful defaulters. Okay, right. What are the banking site causes for default? Wrong person. We are not identifying the correct person to give facilities. Because I told you earlier, today we are in a very big marketing campaign. By hook or by crook, that increase our portfolio. So whoever goes, පාරයන් එකේවත් අඳගහලා ලෝන් එකක් දෙන්න ඕන. එක සැරේ මට අහුවුණ කේස් එකක් මැනේජර් කෙනෙක් අර මියුනිසිපැලිටි එකේ පාර අතු කරන ගෑනු කෙනෙක් අඳගහලා ලෝන් එකක් දුන්නා. මියුනිසිපැලිටි එකේ පාර අතු කරන ගෑනු කෙනෙක් අඳගහලා ඒ ගෑනු එයාට ලෝන් එකක් දුන්නා. credit need එක identify කරලා නෙවෙයි දෙන්නේ. It's serious cases we give us practically. Otherwise, because you are given a target to achieve, most of the bank managers, what you do, you select good customers who have been paying regularly without any difficulty. Loan top up. How long you can top up? Who attend a top up? Not identify the person. You credit need a loan, otherwise you create a credit need for a person. Now new environment with this SME sector lending, we have to create need for the lending. Objective need a create card. Then you can identify the person. Whom can you? Second one is wrong timing. Because we have our difficulties. Customer will have when he is in the tight schedule. So we don't have much time to evaluate or do all these things and try to dispose as early as possible. Sometimes we take our own cool time and analyze everything. When you grant the facility, customers' need has been finished. Wrong time. Most common factor what we used see in this research was the wrong amount. What the customer need is not given. What is given for what we wanted. The amount the manager wanted. Manager loan customer loan. Some other managers have their factories. The customer comes and asks for a 1 million facility. Point blank cuts. Not looking for any analysis. What do? If for such case what happened? The customer balance 250,000 he borrows from the local market money lenders, street lenders. And which story is first servicing first? So our loan is waiting for back. Then the NPA loan here. Long period. This is another problem. We have set out in a certain our banking practice either 3 years or 5 years. Either 3 years or 5 years. It has in there. How do they the customer repayment ability, but we have to decide the period. It can be less than 3 years or more than 3 years, depending on the customer repayment ability. But what we do, we fix the period. We loan it 3 years, 5 years. Whenever I asked most of the participants in the examinations, they say that then you are Bahi, no Kolu, Samekala, Kasabra, Samekala, Arul Bahadino. Only Kala Dino, a Pagala Dino. In once funds will misused and will not pay. So imperative material. Problem here is most of the manager does not know what is it. That is your delegate authority. 3 years or 5 years is your delegated authority given under your credit administration circular. एक नई बेस कराने वाली customer repayment ability, cash flow, base color period design. So these are the causes what we found responsible defaults. So the bankers are responsible mostly for the defaults. So why we worry? How we do? How we do that? Can we relax? You want to relax a little? So if this continued, our banks may face severe difficulties. Sometimes you may find, I'm calling you about the first scenario, central bank direct you to increase your capital. So the two options given, one is going for public share issue, other one is increasing your recovery. If you can't increase your recovery, your survival will be threatened. Your job security is threatened. If your bank has to face severe consequences, restrictions on the central bank, then you will personally face for it. He will have the okay, so these are the factors we have decided. Finally, what are the we have learned about 5 C's of credit, no? And these are the 5 C's of bad credit. First one is complacency. Expecting the past good things in the future as well. I mean, we are given the facilities to the customer for last 2-3 instances, he was paying very well. Well, so therefore, Suddhavage given once. What's the guarantee? We are granting a facility to recover unknown, uncertain future. The future conditions are not known. Past conditions are favorable for him to pay. He's okay, good, well, but his circumstances of the future may change. So we cannot predict those things. So we are taking a risk. So don't expect past good things to be happen as it is in the future also. It may change. Second one is carelessness. Every time to postpone it. One problem is customer delayed the the proposal. Customer gives an application, expect within a certain reasonable period, loan will be approved, or else at least you tell that it cannot be entertained without dragging. Most of the time we say you have no priority. Poor understanding about the customer's request. This carelessness, you postpone every sometime, you postpone and forget sometime. Especially certain information customer given, you are not recorded. You postpone to, I'll do it later. So you forget because the pressure of work. So custom is getting delayed. When the custom is delayed, what is the position of the bank and yourself? How the customers are what you call categorizing your bank and then never and understand your credibility will get lost. The other factor is communication. One thing, as we never granted a facility, before granting a facility, terms and conditions has to be discussed with the customers. It never happens. If it happens, customer have some idea about the loan repayment, even at all this communication with the customer. Very, very low. So therefore, you are not the very important information you may not be able to get from the customer. Your rapport has to build up. It's a part of the customer relationship management. In credit, it's very, very crucial. Then we forget about the contingencies. Ignore circumstances which can be known by default. We never thought about the corona. But if anything happens, contingencies are unexpected things can come in the future without our knowledge. So we have to anticipate those things can happen. We have to anticipate this thing can happen. Therefore, we should have what you call second plan or the alternative plan we should have there. And negotiate the customer, discuss it, to have a negotiate for any negative thing happen, how to overcome some of that without waiting till it happen. Before that, should have a plan. Those called contingencies. The final one is competition. What is competition? In the competitive market, customers comes and put certain pressures on us. Other bank, we have a bank, we have a they are the bell. This practice is common. Competitor behavior. In the competitive behavior is also very important. Sometimes you may find the competitors are behaving in a manner which is not unethical manner. One time I get a customer came and told me that certain bank, private bank was selling to the customer SIM. Rajya Bank information don't give any information to state banks, Bank of Sri Lanka Papers Bank. Because they are coming out finance minister, no? So they are openly giving information to the Inland Revenue Department. So we are giving the information, competition, cutthroat competition. Try to put the other competitor down. Similarly, on the other side, customers also comes and tells us, other bank may bank may. So one of the case, I similar case I give, when I working. One customer came and told that a certain bank, private bank, say that they are offering, and I offered 12%, he said 10% of the other bank they don't give. So I said, okay. One thing I shall give you a call and I ask on that manager whether they are giving that rate. I don't know tell you that this is real lie. What I did, yes, I told, okay, if that bank is giving at you 10%, why don't you take it from them? My rate is 12%. Why are you coming for me and asking me to give a 10%? Because since your one bank is offering you 10%, no? Well, get it from them. It's okay, I don't mind. Problem is, a bank would then chase, they're chasing. Hello, Radin. Okay, these are some of the bad effort which have been into bad credit. So finally, let us go for the process of non-performing advances. In next week, we'll discuss monitoring, supervision, and follow-up, and try to identify the warning symptoms. the causes for failure. This is a process of recovery management. I try to manage non-performing advances. What is monitoring, what is supervision, what is follow-up. Then try to identify warning symptoms. What are the warning symptoms? Where the warning symptoms are coming in? Then identify the causes for failure, why the business fails. Then try to analyze the core problem. I started with this. Identify the customer's problem and try to solve the problem. Our problem automatically solved. Okay. Finally, we have what are the recovery options or the alternatives? What are the recovery options available as we discuss in detail final sessions. Okay, this is the process of my conducting this session. So next session will be on monitoring supervision, and then after we identify the causes for failure, and then try to analyze what are the recovery options available. Okay, thank you very much for the day. Any questions?